Hello everyone, John AG here, and I need you to lock in because something just happened in the US bond market that almost nobody is talking about the right way. In the last 12 months, India quietly dumped roughly $50 billion worth of US Treasuries. Not 5, not 15, around 50. And if that number doesn't hit you in the gut, it should, because India isn't supposed to do that. For decades, India played the safe and boring game. Earn dollars, park those dollars in US government bonds. Keep it simple, keep it stable. But late 2025, that pattern snapped. And once you see what India is swapping those bonds for, you'll understand why this is not a routine portfolio tweak. It's a signal flare. Now, quick favor before we go deeper. I'm running a campaign to push back against copycat channels that rip original work and flood the space. If you value real analysis, subscribe and drop OG John AG in the comments, so I know who's really riding with me. And one more thing, if you want daily updates, extra posts, and my personal takes that I don't put on YouTube, I launched a WhatsApp channel. It's got premium notes, quick voice updates, and instant alerts. Link is in the description. Join it right now so you don't miss the moves between videos. All right, so what happened exactly? According to the latest international holdings data, India's treasury pile fell from about $241 billion down to around $191 billion over a year. That's a drop of roughly 21%. In plain English, India took a chainsaw to its US debt exposure. And here's the part that makes this spicy. They did it while yields were high. Think about that. US Treasuries paying in the 4% range are usually catnip for conservative money. When the yield is attractive, central banks typically buy, lock it in, and call it a day. India sold into high yields. That's not rate shopping. That's risk management. So the big question is, why would a major central bank walk away from a so-called risk-free return? Because sometimes the biggest risk isn't the interest rate. It's the system. And this is where most people get lost. They assume a country sells bonds only when it's desperate, when the currency is collapsing, when reserves are drying up, when they need emergency dollars. But that explanation doesn't fit here. India's FX reserves have been sitting near record levels. The country has liquidity. The rupee hasn't been doing a dramatic free fall compared to other emerging market currencies. In other words, this wasn't a forced sale. It looks like a choice. So if it's a choice, then it's a message. And the message is simple. We don't want to be trapped. To understand the trap, you have to rewind to what the world learned in early 2022. Back then, the West showed everyone a new weapon, freezing sovereign assets. Huge chunks of a nation's reserves, locked up, unreachable, unusable, because the politics changed. That single event rewired how every independent country thinks about reserves. Because if reserves can be frozen, then reserves aren't reserves. They're permission slips. And India is one of the most strategically independent players on the planet. They buy energy where it's cheapest. They buy weapons where it makes sense. They work with multiple blocs, multiple alliances, multiple agendas. That's the whole point of their foreign policy. Flexibility. But flexibility becomes dangerous if your national savings sit inside someone else's system. If you're holding hundreds of billions in another country's paper, inside another country's legal framework, and that framework can be weaponized, then you're not holding an asset. You're holding a lever someone else can pull. So when India sells treasuries, you shouldn't just think bond trade. You should think sovereignty trade. Now here's the cliffhanger, that $50 billion didn't vanish. It didn't burn up. It didn't teleport into thin air. It moved. And the direction it moved tells you exactly what India fears next. Now, let's get even more specific, because the details here are where the real warning signs live. When people hear treasuries, they automatically think safe. But safe is a word that only makes sense inside a stable political environment. A treasury bond is safe from default only as long as the issuer can always refinance, always tax, and always print. It's safe from volatility only as long as there's a deep buyer pool. And it's safe from confiscation only as long as the rules never get rewritten. India is acting like they no longer believe that last part. Because in 2025, the risk isn't just, will I get paid? Or the risk is, will I be allowed to access what I own? That is a completely different kind of risk, and it's the kind that doesn't show up in yield charts. Imagine a future headline. A major geopolitical crisis breaks out, and Washington demands alignment, votes, sanctions, access, cooperation. If India says, we're staying neutral, what's the pressure point? Trade access, payment rails, reserve assets. That's why holding paper claims inside someone else's system can feel less like savings and more like a hostage note. And if you think I'm exaggerating, ask yourself this. Why would a country spend money, take security risks, and run a complex operation to relocate gold? If they were confident, the world would stay calm and cooperative. They wouldn't. They'd leave it where it's convenient. So when India moves metal home, it's a vote of no confidence in future access. And here's another layer most people miss. Gold held abroad can be used by the system. It can be leased. It can be pledged. It can be tangled in layers of claims that make it look like it's everywhere at once. But gold held domestically, under sovereign control, is harder to turn into somebody else's liquidity. It's harder to manipulate. It's harder to quietly encumber, which raises a scary possibility. What if the real goal isn't only to own gold, but to remove gold from the Western balance sheet machine? Because if enough countries do that, the paper gold market can start to look under-collateralized. And when paper promises get questioned, physical premiums explode. That's why this isn't just a bond story, it's a trust story. And it's why I keep saying, watch what they do, not what they announce. One more reminder. If you want my real-time notes when data drops, the WhatsApp channel is where I post first. Link below every day. Because when a central bank exits paper claims, it usually runs toward the one reserve asset that doesn't require trust, doesn't require counterparty, and doesn't care about geopolitics. Gold, but not just buy gold. The bigger story is what India did with the gold it already had. Most people don't realize this, but for years, a significant portion of many countries' gold has been stored abroad, mostly for convenience. It's easier to trade, easier to lease, easier to use inside the Western financial plumbing. The problem is, convenience is the opposite of control. Gold in a foreign vault is still your gold until it isn't. So India started bringing it home. Reports and disclosures around 2024 and 2025 showed India moving large quantities of gold out of overseas vaults and back onto home soil into domestic, high-security storage. This isn't symbolic, it's operational. Let me translate what repatriation really means. It means, if the world breaks into hostile camps, we want our wealth behind our own walls. And that decision has a backstory, one that still stings. In the early 1990s, India faced a brutal balance of payments crisis. The country needed emergency funding, and to secure it, India had to pledge physical gold as collateral, gold that was shipped out under pressure to satisfy external lenders. It became a national scar. So fast forward to today, India isn't being forced to send gold out. India is choosing to pull gold back. That reversal matters, because you don't do a massive physical logistics operation, moving heavy metal across borders, unless you're preparing for a world where paper promises might not hold. And the timing is what makes this even more intense. India didn't start this when markets were calm and friendly. They accelerated it in an era of sanctions, trade fractures, currency wars, and political distrust. So when you see India reducing treasuries and repatriating gold in the same window, you're looking at a coordinated pivot. Now, I know some of you are thinking, okay, John, but every central bank buys gold. So what? True, but the pattern matters. India's gold share within its overall reserve mix has been rising, and the value of that gold has crossed major milestones. You don't need to believe any one headline to see the bigger behavior. Less reliance on U.S. paper, more reliance on hard reserves. And notice what they're avoiding. They're not just diversifying into euros or pounds like it's 2010. They're going into an asset that can't be frozen by a banking message. An asset that doesn't sit inside a foreign legal system. An asset that doesn't require anyone's permission. That's not a return decision. That's a regime decision. So here's the next question you should be asking yourself. If India is de-risking from the U.S. Treasury market, who is buying? Because somebody has to take the other side. The U.S. runs massive deficits. Those deficits are funded by bond buyers. If a large, steady buyer steps back, the market must replace that demand somehow, either with other foreign buyers, domestic institutions, speculative funds, or the central bank itself. And the more the buyer base shifts toward leverage and short-term players, the more fragile the system becomes. That's the part Wall Street doesn't like to say out loud. They'd rather keep the story simple. Only one country is selling, everyone else is fine. Because complexity scares markets and fear raises funding costs. But in the real world, complexity is exactly what's happening. India is the swing state of the global economy, big enough to matter, growing fast, and connected to multiple power centers. If India changes behavior, it's not noise, it's signal. And the signal is the automatic bid for treasuries from the global south is weakening. For decades, the model was predictable. Emerging markets export, earn dollars, recycle those dollars into U.S. debt, keep currencies stable, keep trade flowing. That recycling supported U.S. borrowing and helped keep interest rates from exploding. But now, countries want options. They want trade that doesn't pass through one gatekeeper. They want reserves that can't be frozen. They want a backup plan, and India is building one right in front of us. You can see it in how India has been experimenting with settling trade in its own currency. You can see it in efforts to set up accounts and mechanisms that let partners pay and get paid without defaulting to dollars every single time. Are those systems bigger than the dollar today? No, but they don't need to be bigger today to matter tomorrow. Because infrastructure is about direction, not size. Once the plumbing exists, volume can grow fast, especially if the political environment forces it. And here's where it gets personal, because this isn't just a macro story for economists. It affects your cost of living. If foreign demand for U.S. debt weakens, funding becomes more expensive. If funding becomes more expensive, the pressure rises for more financial engineering, more balance sheet magic, more solutions that usually end with currency debasement. And currency debasement isn't just a fancy word. It's your grocery bill. It's rent. It's the price tag on everything that used to feel normal. So yes, India selling treasuries is a global chess move, but it also hits your wallet in slow motion. Now, before we move into the what it means for you part, let me slide in something quick and genuinely useful. If you're into silver-related success stories, like real people who caught moves early and built life-changing gains, there's a separate channel linked in the description. Hit that link, subscribe over there too, and binge a few stories, because sometimes seeing what's possible flips a switch in your brain. All right, back to the main plot. Why does India want sovereignty right now, specifically? Because the world is splitting. Not cleanly, not neatly, but unmistakably. We're moving from a single dominant system to a world of blocks, competing payment rails, and friends-first trade. In that world, holding a giant chunk of your wealth inside someone else's debt market is not safety, it's exposure. So India is rebalancing toward assets that can survive political weather. And let's be honest, that's not irrational. Because the rules of the so-called rules-based order have been rewritten in real time. If a country can wake up and discover its reserves are locked, every country has to ask, what if we're next? This is why physical control matters. Paper assets live in databases and legal frameworks. Physical bullion lives in vaults and geography. And geography is harder to hack. So now we arrive at the uncomfortable implication. If major nations keep reducing Treasury exposure over time, the U.S. has two choices. Either offer higher yields to attract buyers, or rely more heavily on domestic support mechanisms that ultimately expand the money supply. And both roads have consequences. Higher yields pressure the economy and the government budget. More money supply pressures the currency. And either way, the era of cheap and easy funding becomes harder to maintain. Now let's zoom out, because this isn't just about India. This is about a trend, decentralization of reserves. Countries are learning that diversified doesn't just mean different paper, it means different risk category. That's why gold keeps showing up in these stories. Gold is not just an investment, it's a neutral settlement asset. Gold doesn't care if you're aligned with the West, the East, or nobody. Gold settles. And when trust is low, settlement beats promises. Now, if you're watching this and thinking, okay, but what do I do with that? Here's the practical framework. No drama, just reality. First, pay attention to what the biggest players do, not what they say. Central banks are not trying to impress you. They're trying to survive. When they shift reserves, they're telegraphing risk. So if you see a steady pattern of large nations favoring hard reserves over paper claims, don't shrug it off. Ask yourself what scenario they're hedging. Second, don't be the person who is all in on one jurisdiction. That doesn't mean panic. It means balance. It means thinking in baskets. Currency basket, asset basket, jurisdiction basket. Because the future we're drifting toward is not a world of one stable universal system. It's a world where systems compete, and sometimes systems break. Third, watch the physical signals. Announcements can be spun, accounting can be massaged, but moving metal across borders is loud. If you start seeing more repatriation, more countries pulling gold home, treat that like a flashing warning light. Because repatriation is what you do when you suspect access could be restricted later. Now, let me ask you something, and I want you to answer this in the comments because I read these. Do you think India is preparing for a future sanctions world? Or are they preparing for something even bigger, like a full reset in how global trade gets settled? And second question, if more countries follow India and reduce treasury holdings, who do you think ends up absorbing the supply? U.S. households, big institutions, or the central bank through the back door? Drop your thoughts below. I want to see what the smartest people in this audience are thinking. Also, and I mean this in a friendly way, if you're doing well right now, if you've had a win, a breakthrough, or you've improved your situation in the last year, share a quick success note in the comments. It helps other people stay motivated, and it builds real community. Now, I also want to reward the people who go deeper than the surface. By the time you're watching this, a members-only video should already be live. One video that bundles the latest updates and adds extra in-depth analysis that I don't put in public uploads. If you want that premium layer, join the membership and watch it. It's the easiest way for me to see who's truly following closely. All right, let's bring it home with the core takeaway. India cutting around $50 billion in treasuries isn't a random headline. It's a sign that the automatic trust era is ending. When a major, fast-growing power chooses to reduce exposure to the world's reserve debt market, while simultaneously increasing hard reserve control. That's a strategic pivot. And pivots happen before the crowd understands why. So don't wait for mainstream explanations to feel comfortable. Comfort is expensive. Instead, do what smart money does: watch behavior, track incentives, and position before the narrative catches up. Because if India, the country that was once the quiet, predictable buyer, can change its mind this aggressively, then the next quiet buyer can change too. And when enough quiet buyers leave, the market doesn't crash with a siren. It cracks with a whisper, so make sure you're not listening only to the sirens. If this helped you understand what's really going on, hit subscribe so you don't miss the next update. And remember, drop OG John AG in the comments if you want to support the campaign and keep original analysis alive. Take care of yourselves, take care of each other, and I'll see you in the next one.